There is a system that operates your life every single day, yet you have never signed any agreement with it. Have you ever heard the name Rockefeller? He created an operating system that, more than 100 years later, is still valid and still delivers enormous value. The Rockefeller system. You did not vote for that system. You did not sign up for it. You were never asked for your opinion. But this morning, you obeyed it at least 4 times before you even left your home. You filled up your car with gas. You opened your phone. You searched for information. You ordered a necessary item. Each action is very small, separate, harmless. But when you string them together, they form a path that feels suspiciously familiar, a path that billions of people around the world are walking at the same time. What is remarkable is not that this system exists. What makes it frightening is this. It works so smoothly that you do not realize you are inside it. There is no secret headquarters, no shadow council, no orders being issued. There is only a cold and highly effective logic. Control the things humans cannot postpone: energy, transportation, information, healthcare, and then make every other path slower, more expensive, more inconvenient. You think you are choosing between different companies, but in reality, you are only choosing different doors within the same building. Each door has its own paint color, its own logo, its own brand story, but behind them, the corridors are exactly the same. This system does not need to force you. It does not have to. It only needs to make its path a little cheaper, a little faster, a little more convenient, until taking any other path becomes abnormal. It sounds hard to believe, but pause for just a moment. Just one moment. When was the last time you bought gasoline without being connected to a few major corporations? When was the last time you searched for information without passing through the same gateway? When was the last time you ordered something online without touching the same logistics infrastructure? The problem is not that you lack knowledge. The problem is this: you do not lack choices, you lack an exit. And to understand why this became normal, we have to go back to the man who laid the very first bricks of this system, John D. Rockefeller. When people mention John D. Rockefeller, most think of oil, monopolies, and unprecedented wealth. But if you stop there, you miss the most important thing. Rockefeller's greatest legacy was not Standard Oil, nor the vast fortune he left behind. His true legacy was a method of organizing markets, a way of arranging capital flows, power, and rules of the game for maximum efficiency, maximum stability, and the ability to sustain itself across generations. This analysis is not meant to judge Rockefeller as good or evil. It is not searching for conspiracies or invisible hands. The focus here is structure, how a system is designed to operate, to spread, and to become a norm that most of us accept as self-evident. Standard Oil was dismantled more than a century ago, but the system Rockefeller created never disappeared. And to understand why, we need to look at the part that very few articles are willing to stop long enough to analyze. What many articles skim over or deliberately avoid is not market share figures or antitrust lawsuits. It lies in the foundational belief that shaped the way John D. Rockefeller acted throughout his entire career. Rockefeller did not see himself as a destroyer of markets. On the contrary, he believed he was fixing them. In the young oil industry of the late 19th century, prices swung violently, and businesses sprang up only to vanish after a single season. To Rockefeller, that was not free competition. It was wasted capital, wasted labor, and chaos. And chaos, in his eyes, was something that needed to be organized. He believed that uncontrolled competition did not create sustainable value. It only produced a downward spiral of price cutting that weakened the entire industry. So when Rockefeller said, "Competition is a sin," it was not a boast of power. It was an economic stance with a moral dimension as he understood it. Order is better than chaos. Efficiency is better than fragmentation. The key point is this: Rockefeller did not break the market through emotion or personal hostility. He restructured it through logic. If a company could produce goods more cheaply, more reliably, and at a larger scale, then in Rockefeller's view, its existence made more sense than dozens of weaker companies coexisting and destroying one another. It may sound difficult to accept, but in the context of that time, this argument was not unreasonable at all. And precisely because it made sense, the system Rockefeller built was able to spread. It did not rely on fear. It relied on efficiency. The problem is this: when an efficient logic is pushed to its extreme, it does not merely organize the market. It ends up shaping the very way the market exists. And to see this clearly, we need to look at how this system operates in reality, through capital flows, bottlenecks, and dependency. Instead of starting with people or companies, start with money flows. Because in any mature market, power does not come from intention, it comes from direction. Capital flows always originate from needs that cannot be postponed. Energy to move, transportation to work, information to make decisions, healthcare to survive. Consumers do not deliberate over these needs. They are compelled to pay for them. This is what creates the system's initial pull. When demand is mandatory, capital flows steadily, regardless of emotion or personal opinion. Next, capital flows through structures. Not through the market in an abstract sense, but through very concrete layers: supply chains, distribution infrastructure, technical standards, licenses, and legal procedures. Whoever controls these layers does not need to persuade buyers. They only need to shape the path that capital is forced to take. Bottlenecks form when one side converges three conditions at the same time: the lowest marginal cost, the largest scale, and rules of the game best aligned with its own capabilities. At that point, competition does not need to be suppressed. It disappears on its own. Small businesses do not exit because they are defeated, but because they no longer have any reasonable way to exist within the same structure. The result is widespread dependency. Consumers depend on it for convenience and price. Small businesses depend on it because they cannot access infrastructure. Even governments become dependent because large structures provide short-term stability for growth, employment, and tax revenue. No one is forced, yet everyone is pulled into the same orbit. This is not a story about personal power. It is a story about capital flows with no exit. When the most efficient path is also the only remaining path, choice becomes formal rather than substantive. And from this flow-based logic, the system is assembled from very concrete pieces, one piece at a time. When we view the system through capital flows, we begin to see that it is not abstract. It is built from very tangible components. Not doctrines, not slogans, but structural decisions repeated over time, long enough to become norms. These are the core building blocks of what is known as the Rockefeller system. The first building block, vertical integration. Instead of competing in a single segment, Rockefeller chose to control every segment. From oil barrels, tankers, warehouses, railroads, to final distribution. This was not meant to create immediate power. It was meant to reduce marginal costs to a level no competitor could endure. When your costs are lower than the market's, you do not need to win on price. You only need to last longer. Competitors, no matter how well managed, will eventually run out of money first. This is not a quick victory. This is victory through endurance. What matters is this: vertical integration does not require malice. It can be entirely presented as an effort at optimization. And in the short term, it genuinely delivers lower prices and greater stability for consumers. But in the long term, it closes market entry points, because newcomers cannot build the entire chain at once without sustaining prolonged losses. The second building block, horizontal consolidation. Once costs are controlled, the next step is not fiercer competition, but reducing the number of players. Rockefeller did not invent acquiring competitors. He systematized it. The strategy was simple: buy those who were willing to sell, and use prolonged low pricing to exhaust those who were not. Eventually, the market no longer has many voices. Not because they are forbidden to exist, but because existence becomes economically irrational. What is notable is that this process is often justified by efficiency. Fewer companies, larger scale, lower costs. But the price paid is the loss of diversity in business models and the loss of the ability to experiment with alternative approaches. When only a few players remain, their mistakes become the mistakes of the entire industry. The third building block, legal structure, trusts, and holding companies. Rockefeller understood very early that economic power required a corresponding legal form. A trust was not meant to produce. It was meant to own. A central entity held shares of many companies that operated independently in name. This structure did two things at the same time. It concentrated control, and it dispersed legal liability. When problems arose, it became very difficult to identify which entity should be held accountable. This structure later evolved into the modern holding company. It is no coincidence that today's large corporations all have a parent company and dozens of subsidiaries. This does not merely optimize taxes. It makes regulations slower and more fragmented, while decision-making power remains centralized. The fourth building block, regulatory capture, capturing the rules of the game. Rockefeller did not merely adapt to the law. He shaped it. When you are large enough, technical standards, safety requirements, and licensing procedures, things meant to protect the market, become barriers to entry. These standards often reflect the capabilities of the dominant players, not the capacities of those seeking to enter. This does not require conspiracy. It happens naturally when lawmakers need expertise, data, and funding to draft regulations. And who has the resources to provide those things? Large corporations themselves. The result is a system where the law appears neutral, but its impact is asymmetric. Large players can breathe easily. Small players feel suffocated. The fifth building block, philanthropy as strategy, philanthropy as a structural tool. This is the most easily misunderstood part. Philanthropy is not fake. Many foundations have funded real research, real education, real healthcare. But at the system level, philanthropy also does something else. It shapes knowledge and social priorities. When you fund schools, you influence curricula. When you fund research, you influence which questions get asked. Philanthropy also helps transform perception, from monopolist to patron. And no less importantly, it is an efficient, tax-advantaged mechanism for transferring wealth while retaining long-term influence. This is not a trick. It is legal design, and precisely because it is legal, it is repeated. When these 5 pieces are assembled, we no longer see a person or a company. We see an operating logic. That logic does not depend on personal morality. It depends only on one thing: whether the pieces work. And in reality, they work very well. The problem is not that this system is evil. In many cases, it produces lower prices, greater stability, and scale that fragmented markets cannot achieve. The problem is this: when this logic becomes the default, every market tends to converge toward the same shape. Fewer players, more concentrated power, many surface-level choices, but an increasingly narrow structure underneath. And when a system has been built on this logic for long enough, the question is no longer who is right or wrong. The question becomes, what happens when you try to break it? If the story ended here, it would seem straightforward. A system concentrates power, and eventually the state intervenes to protect competition. But at this very point, reality turns in a different direction, and this is the most important shift in perspective. In 1911, the U.S. Supreme Court ruled that Standard Oil must be broken up. On paper, this was a victory for antitrust. A giant was shattered into smaller pieces. The market, in theory, would become more competitive. Consumers would benefit. But what happened afterward ran counter to intuition. When Standard Oil was split into more than 30 legally independent companies, their combined value did not fall. It rose. And the greatest beneficiary was John D. Rockefeller himself, who still held shares in most of the new companies. The reason lay not in financial trickery, but in structural logic. The breakup did not destroy the operating system. It merely changed the external form. Each new company inherited the same supply chains, the same technical standards, the same organizational methods, and the same regional scale advantages. Instead of a nationwide monopoly, the market became a collection of regional power centers, far less competitive than imagined. More importantly, the breakup sent a powerful signal. You may be forced to change shape, but if the internal logic remains intact, the system will survive. In fact, it becomes more flexible. Legal fragmentation reduces political pressure, while economic power is preserved through shareholdings, agreements, and historical advantages. From that point on, the lesson for large corporations was clear: do not fight the rules of the game. Adapt to them. If you are broken up, make sure each piece is strong enough to survive. Over time, the market will naturally reconverge. Thus, the destruction of Standard Oil was not an ending. It was an upgrade to the system. And once we understand this, we begin to recognize the same logic repeating again and again across other industries and other eras. To understand why this system is so resilient, let us step away from economic language and think in a simpler image. Imagine the market as an ancient tree. For decades, that tree has grown thanks to roots that run deep into the soil, supply chains, infrastructure, laws, consumer habits. When people realize the tree has grown too large and blocks out the light, the natural reaction is to cut down the trunk. And that is exactly what happened to Standard Oil. But cutting down the trunk does not mean killing the tree. The root system remains intact. In fact, when the trunk is cut, the roots often branch out even more aggressively. From one large base, many new trunks grow. Each trunk is smaller, less conspicuous, but all draw nutrients from an already established root system. From a distance, the forest appears more diverse. But if you look beneath the ground, you will see that everything is still connected. Market systems operate in a very similar way. When a structure becomes too large and is intervened upon, it does not disappear. It adapts. It changes shape. It learns how to disperse its surface in order to protect its core. And over time, the strongest branches once again begin to cast shade over new saplings. The point of this metaphor is not pessimism. It is to emphasize a reality. You do not live in many separate markets. You live in a forest where the paths may look different, but the ground beneath them shares the same root system. And once you see those roots, the next question is no longer who is right, who is wrong, but rather, what happens if the forest continues to grow denser? The warning here is not a prediction of collapse, nor is it a call for panic. It is a conditional warning arising from structural inertia. If a market gradually converges toward 3 to 5 major players, power concentrates not only in pricing, but in the ability to define standards. When standards are set by those already inside the system, newcomers find that the door is not closed, but the ceiling is so low that they cannot stand upright. If rules become increasingly detailed and complex, compliance costs turn into an advantage for those with scale. This is often justified as consumer protection, and in many cases, that is true. But the accompanying consequence is that barriers to entry rise faster than the pace of innovation. Large players can adapt. Small ones grow exhausted and exit the game. If core infrastructure, transportation, data, payments, distribution, is controlled by a small number of entities, competition no longer takes place at the level of the final product, but is locked in at the foundational layer. You may create something better, but you cannot reach users at a reasonable cost. Failure then is not due to a poor idea, but because the path was blocked from the outset. The crucial point is this: the system does not need to become bad to produce negative consequences. It only needs to go unchallenged strongly enough for a long enough period of time. Inertia will do the rest. Today's convenience becomes tomorrow's dependence. Short-term stability becomes long-term rigidity. And once that threshold is reached, change no longer occurs through dramatic shocks. It happens through small but continuous adjustments, moving toward fewer and fewer meaningful choices. The next question, therefore, is not how do we break the system, but rather, how do we recognize the signals that it is tightening one more turn? If this system does not collapse suddenly, then the most reasonable approach is not to oppose it emotionally, but to observe it through signals. Not the signals in news headlines, but small, repeated indicators that show whether the structure is tightening further or loosening. The first signal, the pace of M&A within the same industry. When mergers and acquisitions occur more frequently, especially among already large companies, this is rarely just a story of efficiency gains. It usually indicates that organic growth has slowed, and the easiest way to maintain profits is to eliminate additional players. Not every deal is bad, but when M&A becomes the primary strategy, the market is signaling convergence. The second signal, increasingly dense rules and standards. A healthy system typically has clear but relatively simple rules. When regulations become so complex that only large legal departments can keep up, it is a sign that compliance costs are replacing competition. New entrants are not banned from participating. They are simply exhausted before they can even begin. The third signal, philanthropy accompanied by policy influence. When private foundations do not merely fund research, but also appear in the process of shaping public priorities, you are witnessing soft power at work. This is not conspiracy. It is how the system reinforces itself, by steering which problems are discussed, rather than merely funding the answers. These three signals are not meant to alarm you. They are meant to give you a framework for interpretation. When they appear simultaneously, there is a high probability that the system is entering a phase of higher concentration. And at that point, the important question is not whether you like it or not, but rather, where do you stand within that flow? At this point, The story may have become clearer, but it also leaves behind an uncomfortable feeling. Because this system does not resemble problems that can be solved with a simple right or wrong decision. It is not an on-off switch. It is a prolonged trade-off. Efficiency or competition, low prices and convenience, or diversity and genuine choice. We often say that we want a free market, but when faced with two very concrete options, on one side, products that are cheaper, faster, and more stable. On the other, a fragmented ecosystem that is more expensive and riskier. We usually choose the former. Not because we lack morals, but because life forces us to be practical. And that is the greatest paradox of this system. It is not imposed from the outside. It is reinforced every day by our own rational choices. Each small, individual decision, not worthy of condemnation, yet when added together, they create immense inertia. So the question is not, was Rockefeller right or wrong? Nor is it, should this system exist at all? The much harder question is, without such structures, would the world truly be easier to live in? Or are we simply trading one type of risk for another? And most importantly, as the system continues to concentrate further, do you want to be someone who stands outside observing, someone who resists, or someone who understands it well enough not to be swept along unconsciously? If you have made it this far, you have probably realized something important. Understanding the system does not make you more pessimistic. It simply makes you less naive about what appears to be natural. The Rockefeller system is not a story meant to frighten you. It is a map. And a map, even if it does not immediately change your path, at least tells you where you are standing. In a world where structures are becoming increasingly complex, seeing the structure itself is already a rare advantage. If you find analyses like this useful, not sensational, not calling for panic, simply trying to connect the pieces, you can follow the channel. Not to believe in a single viewpoint, but to compare more perspectives. In the next video, we will go deeper into a directly related question. Why do antitrust efforts so often fail? Even when there is genuine goodwill, there is no need to rush to conclusions. Just continue observing. Because in large systems, those who understand the structure always have an advantage over those who only react to the surface.